There is one business model on earth that gets paid before it ever delivers anything. It collects your money today for a product it may never actually give you. And if it never has to deliver, it keeps every single cent. That business model is called insurance, and it is one of the most profitable ideas ever invented. Here's a number that should stop you for a second. The global insurance industry controls more than $35 trillion in assets. That is more money than the entire economy of the United States. Some individual insurance companies manage investment portfolios larger than the sovereign wealth funds of entire nations. And the strangest part? Most of that money never came from some genius trading strategy. It came from ordinary people like you, paying a little bit every single month for years, hoping they'd never actually need to use what they paid for. So here's the real question we're going to answer today. If insurance is supposed to protect you, why does it make so many companies unbelievably rich? And more importantly, once you understand how this machine actually works, you may never look at your own policies the same way again. Stick around, because by the end of this, you'll understand a business model so powerful that the richest investor in modern history built a huge part of his fortune on it. Most of us are taught the same simple story about insurance. You pay a small amount. In return, if something bad happens, the company covers the damage. Fair trade. Peace of mind. That's the whole idea, right? Here's the problem with that story. It's only half true. Insurance companies aren't just in the business of covering damage. They're in the business of predicting it long before it happens and pricing it in their favor. And almost nobody stops to ask how that pricing actually works. Let's break this down with something simple. Imagine a small town of 1,000 people. Every year, based purely on statistics, exactly 10 of those people will have a house fire costing $10,000 each. If you wanted to build a completely fair system, you'd collect $100 a year from every person. 1,000 people, $100 each, gives you exactly $100,000, enough to cover all 10 fires. No profit, no loss, just balance. But real insurance companies don't charge $100. They charge $180, sometimes $200. That extra amount isn't random. It's calculated, tested, and refined using over a century of data by teams of specialists called actuaries, whose entire job is to calculate the exact odds of something bad happening to you, sometimes with more accuracy than doctors predicting your own health. Once they know the odds better than you do, they simply price the product above those odds. That gap between what the risk actually costs and what you actually pay is where profit number one begins. But pricing alone doesn't explain everything. There's a second layer here, and it lives inside your brain, not inside a spreadsheet. Human beings are not naturally good at judging probability, but we are extremely good at imagining worst-case outcomes. This is a survival instinct. Our ancestors didn't need to calculate the odds of a tiger attack. They just needed to feel enough fear to avoid the tall grass. Psychologists call this loss aversion. Studies have repeatedly shown that losing something feels roughly twice as painful as gaining something of equal value feels good. So when you imagine your house burning down or your car getting totaled, that mental image feels far larger than the actual statistical chance of it happening. Notice something the next time you see an insurance advertisement. They rarely lead with numbers. They lead with a burning kitchen, a crashed car, a worried parent. The odds come later in fine print. The fear comes first, because fear is what actually closes the sale. This is the second layer of the profit, not just accurate pricing. Pricing built on top of an emotion that makes people say yes without doing the math. But here's the part almost nobody talks about. And once you understand this next piece, everything else in this video will suddenly make sense. Selling you the policy was never the main event. The real business begins the moment your payment lands in their account and just sits there. This is the single most important concept in the entire insurance industry, and most people have genuinely never heard the term. It's called the float. Here's how it works. Millions of people pay their premiums every month. Most of those people, in any given month, don't file a claim. So instead of that money sitting untouched in a vault, insurance companies take this enormous, constantly growing pool of cash and invest it into stocks, into bonds, into real estate, into entire businesses. Think about what that actually means for a second. This is money that technically still belongs to policyholders. Money that might need to be paid out eventually for claims, but until that moment comes, the company gets to use it, completely for free, to generate investment returns for itself. If the investments perform well, the company keeps the profit. If a claim comes in, they simply pull from the massive shared pool to cover it, and the rest keeps compounding year after year, quietly growing in the background while you're not even thinking about your policy. This is not a small side benefit. For many major insurers, the profit generated from investing the float is larger than the profit from actually selling insurance in the first place. Selling policies isn't the main business anymore. It's the funding mechanism for the real business, which is investing. There's a reason the richest investor of the last century built one of the largest parts of his fortune specifically through insurance. Warren Buffett has said openly that acquiring insurance companies gave him access to something almost no other investor could get: a permanent, low-cost, ever-growing pool of cash to invest with, not borrowed money, not risky debt. Premiums paid voluntarily by millions of people who were simply trying to protect themselves. In other words, while you're paying your premium, hoping nothing bad happens to you, that same money might be sitting inside a portfolio, working, compounding, building wealth for somebody else, long before it's ever needed to cover your claim. And here's where it gets even more interesting, because this raises an uncomfortable question. If claims are rare and the float is this profitable, why do your premiums keep going up, even in years when you never file a single claim? The honest answer involves a few real factors, and to be fair, not all of them are villainous. Insurance companies do face genuine risks. Catastrophic events, hurricanes, pandemics, massive lawsuits can wipe out reserves quickly, and regulators require companies to keep enough capital on hand to survive worst-case years. That's a legitimate cost of running this kind of business. But layered on top of that legitimate risk is something else: inertia. Most people don't shop around for new insurance every year. Once you're a customer, switching feels like effort, and effort feels like a bigger cost than a slightly higher bill. Insurance companies know this. Loyalty in this industry is often quietly rewarded with smaller discounts than new customers get, because the math shows most existing customers simply won't leave over a modest increase. So premiums rise partly from real risk, and partly because staying is easier than switching. Both truths exist at the same time. Now here's the moment where this entire video actually becomes useful to you, because understanding all of this changes nothing if you don't know what to actually do with it. The goal of this video was never to convince you insurance is a scam. It isn't. Insurance, used correctly, is one of the smartest tools in personal finance. It protects you from the kind of loss that could genuinely destroy your financial future: a totaled car, a house fire, a serious medical event. Without it, one bad year could set you back a decade. The real insight is this: the wealthy don't avoid insurance. They just use it far more selectively than the average person. They insure against catastrophic, life-altering losses. But they self-insure against small, everyday inconveniences because they understand that tiny risk policies are usually priced with the largest hidden margins, precisely because the company knows you'll rarely ever use them. So here is one simple filter you can use before buying almost any policy. Ask yourself, if this exact bad event happened tomorrow, could I recover financially without this insurance? If yes, you're likely paying for a feeling, not real protection, and that feeling is usually overpriced. If no, if the loss would be genuinely devastating, then the insurance is doing its actual job, and it's worth every dollar. That single question is the difference between insurance that protects you and insurance that quietly funds someone else's portfolio. Here's the thing worth remembering. Insurance companies didn't get rich by breaking rules. They got rich by understanding something about human psychology decades before most people ever thought to question it. That fear moves faster than math, and that a payment collected today, invested wisely, can grow into a fortune long before it's ever needed to keep a promise. So the next time you sign an insurance form, remember what's actually happening. You're not just buying protection. You're funding one of the most profitable business models ever built. And now you finally understand how it works.